Hi, I'm Richa and I'm the head of our premium relationships here at Pepperstone. We've been fielding questions from traders as to why volatility has dropped so low over the last couple of weeks. We've seen it go from 6-month highs all the way down to November 21 lows over the last couple of weeks. Chris Weston here, our global head of research, is going to take us through how, as a trader, you can make the most of the current market conditions. So let's take a step back, Chris. What is volatility and what affects it?
Well, volatility is movement. So there's statistical volatility where we're looking at what's happened, or realised volatility, and that's effectively how far prices are moving away from a mean. We measure that typically in annualised standard deviation terms. Or we can look at implied volatility, and that's generally in the options market. We're looking at the levels of expected movement over a set time frame as well. We can also look at the sort of degrees of movement in price. Typically, people will use indicators like average true range, average daily range, Bollinger Bands. So these are kind of all realised volatility measures. But effectively, we're looking for the degrees of movement from a set point. And, that has huge implications for us as traders. We need to be adaptive to changes in volatility. It affects how our leverage ratios, our risk management, how much risk we're taking on, position sizing, the direction of markets. So for me, volatility, in terms of reacting to those degrees of movement and price changes, is absolutely, it's hugely important, and it's pivotal to financial markets.
And a lot of our consistent traders do look at changing the way they look at their risk appetite, their position sizing and leverage based on what market conditions are doing and what volatility is doing. So if we talk about some of the key elements of what affect volatility, let's look at central banks. What part do they play in volatility?
Well, I think, you touched on this idea that we have seen this suppression in volatility really since mid-March. I mean, we were coming to a situation where mid-March there was incredible, highest levels of realised volatility in the bond market and also interest rate markets that spilled over into big volatility into FX markets. We saw the VIX above 30%, but it's come crashing down, as you point out. The question is why. So central banks, let's focus on that. First of all, the response from the Federal Reserve to the banking crisis was meaningful. I mean, the various liquidity and credit facilities were set up have been really well taken back, and they've staved off a systemic issue. I think we also talk about liquidity. I mean, liquidity to me is the oxygen in financial markets, and we have seen balance sheet expansion from the Federal Reserve. We've seen reserves on the Fed's balance sheet up about 12% since March. I think that's been very supportive. The TGA account, the Treasury General account, has been drawn down, quite sharply. Although I think it's going to rebuild pretty sharply over the next 6 months or so. But that's been seen as an idea of additional liquidity. So I think those factors have been very, very supportive there. I think liquidity is something we do need to look out for going forward, but certainly those couple of factors have been very positive.
Yeah, excellent. And the second thing to look at is what are the structural changes in the key players in the market?
Yeah, I think ultimately, low volatility begets low volatility. So I think there's a number of factors that we need to look at. First of all has been the rise of these zero DTE options, the daily tradable expiries, and daily time to expiries effectively. So a lot of the volume's going into there. Now, the reports on the street is that market makers or option dealers are long calls, and effectively what you're seeing that in the price action right now in the S&P, if you pull up a daily chart, by their gamma profile, what we're seeing is effectively every time the market falls, they've got a vested interest in coming out and buying S&P futures, and when the index rallies, you tend to see a situation where the market makers will go out and hedge their exposures by selling the futures, and that has a mean reverting effect, and that also has a big suppression of volatility coming through. I think if you look at commodity trading advisors or trend followers who trade managed futures, they're max long equity futures at the moment, so that's helped. And also risk parity funds. These are hedge funds that are dynamic to volatility. And when you see that standard deviation or the realised volatility falling in the market, what you tend to see is a higher asset allocation into equities. And again, that just suppresses volatility. So if you're looking at the range of players, we do see a situation where falling volatility manifests into lower volatility in itself. And I guess without risk of getting a bit technical, if you have a look at the VIX futures curve, there's a strong backwardation. So each futures contract gets higher and higher and higher. And by being short in that situation, it incentivizes funds to be short, because when you get the expiry, you roll up at cheaper levels or better levels effectively. So again, the futures curve is very, very positive to be short. So the players themselves are very important in the structural lower volatility we're seeing.
Yeah, excellent. And lastly, speaking on risk as well, we're seeing a lot of companies buying back their own shares. Is this something our traders need to be looking at?
Well, I mean, this is sort of information that you get people plastering over Twitter, but yeah, absolutely. Throughout this reporting season, over previous reporting seasons, we've seen the companies themselves announce buyback authorizations of close to $400 billion, which is a record amount. So it's actually the companies themselves who are the biggest buyers of stock out there. And of course, that's taking earnings per share out of the system. It's boosting share price and it's having an effect on lower volatility. I will just say one other thing. There's two other things that we need to think about. One is the fact that the US dollar has fallen, recently fell about 4.5%, nearly 5% on the dollar index. And I think that weaker US dollar has been very helpful in reducing volatility. The other factor is, of course, if you have a look at interest rate pricing after a really big move in expectations because of what we saw in banks, the fact that banks are more stable is if you have a look at Fed funds pricing, we're seeing the market fully discounting a 25 basis point hike in May. But then after that point, Richa, it's an extended pause. And that lack of action is saying to the markets, well, we need to be data dependent now. And that's also reducing volatility. So the point is, there's a lot of different reasons as to why volatility's fallen. It's not one single factor. You can sort of cherry pick one, which is probably more dominant than the others, but there's a whole multitude of reasons we've list there.
Yeah, excellent. And as a trader now, generally our high value traders love a good opportunity in the market when volatility is a little bit higher. But now that we're looking at lower levels of volatility, what are some of the strategies that our traders can look at to make the most of the current market conditions? Yeah,
it's a great question. You've got to be dynamic to volatility. I'll ask you about the risk management side in a second, but as I talked about earlier, when you get these participants or the market makers in options, especially who have a vested interest to sell strength and buy weakness, pull up a daily chart of intraday chart of the S&P futures or US 500 with us. You see a situation where the market just mean reverts. That's why we get these low close to close percentage changes. Yeah. The ranges are coming down on a lot of these markets, but the close to close prices are very, very much unchanged, and therefore mean reverting strategies are working really well. So trend following, momentum strategies, you've got to go into the time frames, but on a 4-hour chart or a daily chart, mean reversion is the strategy which is working best at the moment. The question is at what level do you want to be looking to sell strength and buy weakness? That's the key issue. The other factor is in this environment where you get positively trending equity markets, on range-bound equity markets, but also very low levels of volatility, not just in equity markets. FX vol is shot to pieces. We're seeing bond volatility moving a little bit lower. Carry strategies work really well. Yes, the idea of being paid to be in an FX position works really well. So those high-yielding currencies typically outperform in this environment as well. So, we look at strategy and diversification in strategy. So it's really important to know what works and adapt those strategies to the low vol environment. But from a risk management perspective, I'll ask you, in terms of client positioning and the sort of flow that you're seeing and talking to people, how are people adapting from a risk management perspective to these markets?
That's a really good question. And the important part of that is that people are adapting. Often when you see those high volatility periods as well, our profitable traders look to manage their risk. So they look to using maybe lower leverage. They've got tighter stops and they manage their stop loss, their risk rewards according to what the market volatility is doing, not just looking at price levels in the market, but how much the average true range might be at the time, looking at the Bollinger Bands, the expected movement, the mean reversions at the time. So it comes down to managing it based on what the volatility might be. So at the moment, now that volatility is a little bit lower, we're looking at clients looking at higher leverage, taking on a little bit more risk and being able to manage their stops in a way that they are a little bit tighter stops and changing their risk reward based on what the market is being able to present to them.
Yeah, I think that's important, to be dynamic, not just in terms of strategy, and deploying the right strategy for these markets, but actually, the leverage is a really key one. March, I would imagine people would have taken those leverage rates down across asset class, but also, traded in that situation with a slightly wider stop and taken the position size down. So it's really important to be dynamic to volatility. Yeah.
Yeah, excellent. And lastly, Chris, do you think markets are complacent?
Yes and no. If we knew the answer to what's going to cause a massive breakout in volatility, we'd be trading it. We let the market come to us and show when there's a theme, especially one that's going to be ongoing, that we'll trade it. The two things that I think that are really important is liquidity. So I do think that we're going to start seeing the Fed's balance sheet roll off at a much faster pace. I think we're going to see reserves on the balance sheet, coming down. I think we've seen a peak now. I think reserves are going to fall at a much more precipitous place. I think the TGA, the general account, is going to build pretty sharply. And I think over that period, then that's going to be a really dominant driver. The interesting thing, Richa, is everyone's talking about the debt ceiling now, and we're trying to work out when the X date is for the debt ceiling. The actual perverse situation is once it's rectified, and we know at some stage it will be agreed on, that's going to allow the Treasury Department to issue about $1 trillion worth of short-term paper. Someone's got to absorb that paper. It's going to be the private sector, and that's going to be seen as a massive amount of QT liquidity withdrawal. The other factor, I think, would have to be a deterioration in growth economics. So the growth data points, that we start really pricing in a much more tighter degree of a recession. Cyclical assets will get pretty badly beaten up on the back of that. The need then to come out and cut rates will obviously manifest. So I think we need to see a trend in some of the growth data points. We're not there yet, and obviously one swallow doesn't make a summer. We need to see a trend in that. And I think if we were to see a bigger credit crunch and growth economics falling away at a time when inflation stays sticky, I don't think the market would like that, and I think we'd see a much higher volatility regime.
Yeah, exactly. And I think the big takeaway from this is that volatility might be a little bit lower, but it's not about what's in the current market, but what the opportunity that it presents based on your own risk appetite and optimizing as the market changes, which is the most important thing when it comes to trading in various different market conditions.
Cool. Anyway, so that's I think that's what we're looking for today. If you've got any questions around anything you've heard around the risk management side of things, some of the factors that are suppressing role, reach out to Richa, myself, or anyone of the team at Pepperstone. Otherwise, good luck with the trading.